Hey, what's good, self-directed investors? How are you doing today? And welcome back to another episode of ETFs Explained. I'm your host, Jordan, and if you're new to the channel, I'm the mind behind MakeMoreCapital, the financial education brand that hopes to make everyone a little bit more financially literate. And today we're going to be talking about 3 high dividend yield ETFs that trade on the New York Stock Exchange that U.S. investors can get exposure to a wide variety of companies inside of one single asset and get paid dividends just for doing so. The 3 that we're going to talk about today is the Schwab Strategic U.S. Dividend Equity ETF, which trades on the New York Stock Exchange, the SPDR S&P Dividend ETF that trades on the New York Stock Exchange, ticker SDY for this one. The other one, the Schwab one, is SCHD. And lastly is the Vanguard Dividend Appreciation ETF, VIG, which also trades on the New York Stock Exchange. Now, these are 3 different ETFs that mostly focus on dividends. So what we're going to see as we look through them is they're invested in mostly high dividend yield or dividend aristocrat companies, which means companies that have a consistent history of paying dividends for like a period of 20 years plus. So they've always reliably been paying back dividends to their shareholders, and that is a great incentive for especially long-term investors who use their, for this example, as these are American, or as these trade on the New York Stock Exchange, these are great assets for U.S. investors to use their Roth IRA, invest after-tax dollars, and just reap the benefits of dividends, reinvest them over time, and compound their way to wealth that way. So today, SCHD closed off at $57.28. So this one has the lowest share price out of the 3 that we're going to touch on. SDY finished the day at $96.36 a share, and Vanguard Dividend Appreciation ETF finished at $130.59 a share. And just looking at these charts, we can see that at least this Schwab ETF SCHD has been around since 2011, started at $25.47, and today in 2020, it's sitting at about $57.28, a little bit below its high of earlier this year. However, you can see that again, over time, it has at least compounded an entire cycle and doubled once. So you can definitely see some consistent growth over time with this ETF. With SDY, this one is a bit older. It was created in 2005, started at $54.44. As you can see here, 2008, it took quite a dip. So this would have been a perfect opportunity if you had cash to buy more shares for cheap, because of course over time they rose back up, became more valuable. And so although this ETF, it did at one point, so earlier in 2020, it had doubled what the share price was when the ETF started trading. So again, if you've been invested in this one for a long time, there's certainly some appreciation growth, but the main reason why you want to get these is for the dividends. Now, I do apologize, I haven't even mentioned the dividend yield in this, but we'll be getting into that once we actually look at the ETFs. This one was at 3.59%. And then if we look at VIG, it seems like it was trading at a very very low price. And here you can see, I didn't end up looking into it, but I'm just assuming, I probably shouldn't assume, but this looks like it was a reverse stock split, which means if you owned, let's say, 5 shares at $9, your 5 shares might become 1 share for $50. And that is why you will see the worth of the shares decrease, or the amount of shares outstanding decrease, but then the single share is worth the total amount of the 5 previously. And since that reverse split, but this one's actually been trading since 1998. But since that reverse split, again, this one saw a dip in 2008, but since then has consistently been chugging along and has doubled in value at least once, and it's halfway to doubling in value again, almost getting up to $150 a share, where it was at $50 a share in 2006. This one has a dividend yield of 1.70. So we're going to talk about these 3. I know I've really focused on Vanguard and BlackRock ETFs, but I did want to mention that, of course, the other important thing you want to look for when you're looking for an ETF to invest in over time is a reliable asset management company. And I've traditionally been looking at Vanguard and BlackRock, but there are many others like Schwab, especially in the US, but Schwab, Fidelity, SPDR, many of them. So we're going to go through them first, though. The Schwab US Dividend Equity ETF. So the first best thing that stands out for this ETF right here is the 0.06% management expense ratio. That is a very, very low MER, which means ultimately you're just keeping more of your money and less fees are going to the asset management company every single year. So the objective of this ETF is the funds inside tracks as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. So this is actually the first ETF I've covered that tracks the Dow Jones Industrial Average, which, as opposed to the S&P 500, which tracks the top 500 companies in the US, the Dow Jones US Dividend 100 Index, I imagine this is an index of 100 companies, but the Dow Jones Industrial Average tracks the 30 well-known reputable companies in the United States. So again, if you look at like the S&P 500, you've got 500 different companies, a little less volatile because there's more. The Dow Jones Industrial Average only has 30 inside, so you would see more price movement because there are less companies in the underlying ETF. But that's something that comes with knowing. So again, if you were looking into buying this ETF, you could search up what this index was, and you'd get a further look. But we'll be able to see what it's invested in. So what is the highlight of this one? Straightforward, low-cost fund offering potential tax efficiency. The fund's focused approach can complement a diversified portfolio. It tracks an index focused on the quality and sustainability of dividends, and it invests in stocks selected for fundamental strength relative to their peers. Now, one thing I just want to point out here is you don't need to worry about tax efficiency if you are using your Roth IRA account as an American investor, which is the beauty of using these accounts. But the fund details, as we saw, the price point was trading at $57.86. So we can look through some of these details. Now, again, the main thing, though, I always mention in my videos, the three main things you really need to look for is, again, the MER. You want the MER to be as low as possible. The management expense ratio, that is the fancy word for fee. You want to make sure the average annual return is fairly consistent over time, and obviously the higher the better. And the third is consistent dividends. So dividends will be a big part of these high dividend yield ETFs, and we'll weigh the pros and cons of them near the end. But so what we can see is that it's actually trading at a bit of a premium right now. So the share price is a little bit higher than the benchmark index, so I guess people want to own it. But if we go through a few of the highlights, so this one was created in 2011. That is what it means by the fund inception. The total net assets, how much money is invested inside of it, is $12.9 billion, a lot of money. Again, the expense ratio, one thing you really want to look for always is very low, 0.06. So that makes this ETF quite appealing, actually. Especially because it's paying a lot of dividends. Now, this one, the index it tracks, the benchmark that it follows is the Dow Jones US Dividend 100 Index. The number of shares outstanding, 224 million. And inside of this ETF, there are 104 companies. So as you've seen in past videos, if you've watched some of them, some ETFs have 3,000 holdings, some have 500. This one is 104. So because of that, it's going to be a little bit more volatile, and it is going to move up and down more. But that also means it does have potential for more growth. And so the large value management style is passive. So again, you always want to look for passive because passive is going to get you that low MER. And the Morningstar category puts it in a large value. So it's got mostly large cap companies, which means they're companies of a market cap of 10 billion or higher. And they are mostly value companies inside, which means they're just solid companies that have been around for a long time and consistently provide value. The market cap is 76.82 billion, and for this one, actually, you see the price to earnings ratio is quite low. I've mentioned before, the sweet spot is between 10 and 20. Anything above 20 is kind of on the high side, so you can see this one is actually trading a bit. It has not reached its high that it was at before the global situation that happened in March, but so that means there's less growth already baked into the current price right now, and a little bit undervalued to where it could be. So that basically means, again, that the low price to earnings ratio just means that there's less growth already in the price, which means it actually should have, or potentially has, more room to climb, and it just, more investors have not realized the value of it yet. And a lot of these details we don't need to get into because the main things you want to look for are those three that I highlight. So let's take a look at their performance. Monthly, let's do quarterly because that's a better way to look at it. Now, if we look at the past 1 year, again, this has been a difficult year for most assets, most investors, except tech, obviously, but this year it's up 1.08%. Over the last 3 years, this ETF, though, is up 8%, which is quite good. Over the last 5 years, 9.5%. Just goes to highlight the growth we saw on the chart over time, and just the growth of, the abundance that we're seeing in economies and markets as well. But if you look at since inception, 12.1%, that's pretty amazing. So ideally, again, you're investing in this ETF because you want to have dividends. You want to be getting paid dividends to reinvest them over time. And if we take this MER, which is 0.06%, and we subtract it from here, you're getting on average 11.95 every year returns plus dividends. That's fantastic. So, once you can identify that yourself in an ETF, then you can do a bit more research and find a couple that you can build your portfolio around. But that is incredible results considering it's returned 12% since inception, and it's a dividend-focused ETF. So good on you, Schwab. So that's the main thing we want to look for there. Pre-liquidation, again, after-tax returns. If you're using the Roth IRA, this really doesn't matter, which is nice. We're just going to close this right here. Performance, go down to portfolio. So what's inside of it? It is tracking the United Parcel Service common stock, Qualcomm, Texas Instruments, BlackRock Inc. common stock. So this actually owns the shares in BlackRock, the asset management company. Pretty reliable investment. Pfizer, Big Pharma, Altria Group, the maker of Marlboro cigarettes, Philip Morris, PepsiCo, Coca-Cola, Verizon, 3M Co. So these are the 10 top holdings. Now, if you were to click here, export all holdings, this is where you could look deeper and find every single investment that's inside of it. But that is the gist of it. Broken down by sector, 24% of this ETF is financials, 17% is industrials, consumer staples, 17%, information technology, 15%. You go down the list, but this is how the makeup of the ETF is. And the ETF is basically, it's made up of all stocks, which we would also call a 100% equity. There are no bonds in this ETF, just a little bit of cash, but that makes the asset allocation a 100% equity ETF, which, again, if you want growth and if you want good dividends, you got to have it invested in companies like this ETF would do it for you. And so the last best thing we want to look for is the distributions, the dividends. So what we can see is that this ETF pays, by looking at it, seeing it's paid June, March, December, September. June, March, it pays dividends every 3 months, which we also know is quarterly. And it seems that when it does pay dividends, it's paying around 44 cents, 44, 46, 48. It's hovered around that price range. So basically, you can think of, let's say you're going to get 44 cents per share, times that by 4 payments a year. And again, I'm not good at quick math in my head, but that's just a bit under $2 a year per share. So if you get that system of dollar cost averaging and buying 1 or 2 shares every single month, you're just going to be accumulating those dividends and you can reinvest them. So that's basically it for this ETF. Just a quick run through. I know some of these videos I've done in the past are quite long, but I just want to really nail down on the 3 main things that you want to look for. So that's it for Charles Schwab and SCHD. Now we're going to look at the State Street Global Advisors SPDR S&P 500 ETF. Now this one is priced at $97.39, and this expense ratio is quite a bit higher at 0.35%. So right there, we look at it, and my first thought would be, well, you're giving up quite a bit of your gains. Now, without a doubt, you're still going to get the right to the dividends, and we'll see what the historical dividends are on this, but you're giving up quite a bit in the gains here. So that's something that would, again, make me probably lean a bit more to that ETF. And again, trades on the New York Stock Exchange in U.S. currency. This one, as opposed to SCHD, has $15.8 million in assets under management. Now, what is the purpose of this ETF? The SPDR S&P 500 Dividend ETF seeks to provide investment results that, before fees and expenses, correspond generally to the total return of the S&P 500 High Yield Dividend Aristocrats Index. So, as SCHD was tracking the Dow Jones Index, the Dow Jones 100 Index, this one is tracking the S&P High Dividend Yield, or High Dividend Aristocrat Index. So again, that's the idea of the index screens for companies that have consistently increased their dividends for 20 consecutive years, meaning that the share of dividend that they're paying out continues to go up over the 20 years. And due to this increase, stocks inside of here both have capital growth and dividend income characteristics, which again makes it appealing to investors because you want capital appreciation, but you also want to make sure you're getting dividends from reliable companies that aren't at some point going to pull their dividend payments, right? Because when you invest, you want to invest for the long run. So this is just more detailed information about the benchmark. One thing I did notice about this site is it's just not, the user experience is not nearly as friendly as some of the other ones. And I thought Vanguard looked a bit ancient. This one could definitely be designed a little bit better. However, let's take a look at the performance. And over the past 1 year, again, has not fared nearly as well as the previous ETF we saw at negative 5.34%. However, in the past 3 years, it's done 4.91%. In the past 5 years, going back to 2015, it's done 8%. And in the last 10 years, it's done 10.94%. So the nice thing is that over time, again, if you're holding it for a long period to collect those dividends, you are seeing hefty returns, at least above 7%. But since inception, if you did buy this, if you bought shares in 2005, it's returned 7.98. So if we were to take 7.98, subtract 0.35, that takes it down to about 7.73. 7.63 because it's 3.5, not 2.5. 7.63. You're still walking away with a good amount of appreciation and returns every single year. But again, the higher that MER, the more money that SPDR gets to keep, and then you get what's left over, right? So that is the performance of that one over time. Let's look at the holdings inside of here. This one is quite focused on, again, the dividend aristocrats. So So ExxonMobil Corporation, 2.24%, AT&T, 2.14%, National Retail Properties, People's United Financial, Chevron Corporation, Federal Realty Investment Trust, International Business Machines, IBM, for short. That's just how I would think to know it. Realty Income Corp. I think this is one of the most well-known REITs, real estate investment trusts out there. Leggett and Platt Incorporated. So these are the top holdings inside this fund. But the sector breakdown, if we want to look into it more, 18% is in industrials, 17% is in financials, 13% in consumer staples, 12% in utilities. And of course, you can take a look and see the breakdown. This one is certainly not as infotech heavy as like the NASDAQ ETFs we've tracked before, which have seen so much growth because they're in these high growth tech companies. And if you look down, you can see the weighting and the distribution. So if you know, and I mean, again, it all just depends on what you're looking for and what your understanding is. But the more you have a general understanding of the industrials industry, which would be, precious metals, oil and gas, different things like that, then it's going to make you more comfortable knowing, by knowing the situation of that industry, it's going to make you more comfortable having your money in an ETF that is more heavily focused on the industrials, for example, financials, and so forth. So it's just, again, I encourage all of you, just keep doing as much research as you can, because the more you familiarize yourself with investing and the different concepts and the jargon, it gets easier for you. But then we will go to, we'll jump up to the dividend distribution for this ETF. And from what we can see here, okay, so that does not seem to be... Okay, so let's just click this one to see the dividend distribution schedule. Oh, gosh. Sorry, folks, this has been a bit messy. But the good thing is that this one actually seems to pay out a dividend every single month. So that is one thing that might attract investors to this dividend as opposed to SCHD. Just because this one seems to be actually paying them out every single month, January, February, March, April. And ideally, the more you're getting paid dividends, the more frequently you're getting paid, the more frequently you can reinvest them, and that actually accelerates the compounding growth. But let's see if we can just find the dividend percentage here. I think that's what I had just looked at previously, and it did not help us. Okay, no, let's find it. SPDR. All right, so we would want to go down and look for the... I do apologize, everyone watching. Feel free to fast forward this. I should have definitely done this beforehand. But again, so we're looking for the S&P Dividend ETF. Okay, here we go, the S&P Dividend ETF. And so it pays out 68 cents per dividend. So that now again, so if you're getting paid dividends every single month and the payout is 68 cents, that would be a pretty excellent investment over time. Because think about it, if now again, I shouldn't do this calculation because I have not checked, and I do apologize for that, but I just want to again walk you through ETF fact sheets to help you get familiar. But that is appealing about this ETF, considering that you would be getting dividends paid out every single month, and at that amount, considering it's invested in dividend aristocrats, that is one appeal, and that is one way that would actually make the MER of 0.35 worth your while. But let's actually just do a little bit of digging. I apologize if you just stick with me a little bit longer. Yeah, it doesn't say the dividend info. So anyways, I do apologize. We could dig into that, but that is the gist of SPDR, S&P Dividend ETF. And that is unfortunately, though, when you find an asset management company with a website that just doesn't give you the information, doesn't have a user experience that's really easy to navigate, you're just not as appealed to use them. So thirdly, though, Vanguard Dividend Appreciation ETF. This one is VIG. This one seeks to track the performance of the NASDAQ US Dividend Achievers Select Index. So this is actually a third separate index. So SCHD tracks the Dow Jones Index, the SPDR SDY tracks the S&P Dividend Aristocrat Index, and this one tracks the NASDAQ US Dividend Achievers. It's a passively managed approach, so again, this one you're getting a very low management expense ratio, which is 0.06, and it's a convenient way to track the performance of stocks with a record of growth. They're growing dividends year over year. So again, this is dividend focused. This is that passive income. And I think as any long-term investor realizes over time, the more passive income, as things get more expensive and costs go up over time, it's good to start that early so that you can receive that and reinvest and eventually live off the dividends. Now, this price is a bit steeper than the other ones, $131.65. And it's a medium risk managed by the Vanguard Equity Index Group. Again, just a few more details. Large blend, so large cap companies blended, and a great blend of what's inside of them. Now, so if we look at these, here, we'll just jump over to the price and performance here. So if we look at the price and performance over the last, 6 years, in the last year, it has returned 6.5%, which is fantastic. Despite everything that's gone on this year. Over the last 3 years, 11.75. So from 2017 to now. From 2015 to now, 11.16. And over the last 10 years, since after the Great Recession, just, barreling uphill, it's returned 12.48. Since inception in 2006, 8.72. So again, if we take 8.72 over time, subtract that 0.06 MER, you're getting, if you've held this since the beginning, you're getting 8.66% every single year, which is fantastic. And 10,000 invested since at inception, you'd be sitting at $34,076. And I think this includes all of the dividends reinvested in. So that is a pretty powerful growth tool this ETF has been. And this actually only looks like 2010 as well. So yeah, from 9,000 up until 34,000, pretty good results. Now let's see what's inside of it. So the portfolio and management, it is always good to take a look, and because this one tracks the NASDAQ, it's got some more growth heavy ones. So we've got Microsoft, Walmart, Procter & Gamble, Johnson & Johnson, Visa, Home Depot, United Health Group, Walt Disney, Comcast, and PepsiCo. These 10 holdings make up 35% of the total net assets that are within the NASDAQ US Dividends Achievers Selects. And this one is made up of consumer services, 22%. We'll start from the top, but basic materials, consumer goods, consumer services. So again, it's diversified for you, and you're just basically getting the profits from all of these different companies. Now, one thing I did want to point out, though, is here, excuse me, the number of stocks inside this ETF is 212. So comparable to the Schwab one, quite a few more companies inside. Comparable to the SPDY S&P one, probably quite a few less. But we see here the PE ratio is quite high at 26.4, which means that a lot of the growth is baked into the price already. So the price potentially has more potential to see a bit of a drop than to continue growing up when the price to earnings ratio is this much above 20. And again, we're looking for that sweet spot, ideally between 10 to 20 for that PE ratio. And finally, let's go take a look at the distributions. The fee, again, 0.06%. You can't beat that. So this would almost be one of the best ETFs or again, fee-wise, one of the best ETFs that you can reap the rewards of the dividends. But this one as well pays dividends quarterly. So you would receive a dividend every 3 months. So June, March, January, September. A lot of these ETFs follow the same schedule. And this dividend has paid out 60 cents, 47 cents, 59 cents, 55 cents, 47 cents, 50 cents. Why did you see such a drop in March of 2020? Well, because of the global situation and what we saw happen to the markets. Unfortunately, that does happen. The companies can decide to pay less dividends, but the main thing is you just want to make sure that the dividends still get paid out. Regardless if the amount goes down, as long as the dividend gets paid out, it's a better sign than a company cutting the dividends off right away. And so if we wanted to, let's say we wanted to buy 1 share of SCHD with $1,000, you take $1,000 your cash and you divide it by the share price of 1 share, and you'd be able to buy 17 shares, which would entitle you to 17 dividend payouts. And again, over time, if you send $200 into your Roth IRA every single month, and you buy 3 shares with $170 or $170 of that 200, you can add 3 shares a month, and you just accumulate those dividends, reinvest over time, and that is the basis of investing. So that seems like that. So I think actually SCHD is quite appealing because of the low price point, and the low price point and the nice dividend payout. So you'd actually be able to accumulate more shares at a price of $57 than you would with SPDY being at $97 or VIG being at $130, right? Your dollars would go a longer way buying into SCHD. So personally, my opinion, despite SCHD, and again, this is not advice, this is just my opinion, but out of these 3, I would probably invest in SCHD just because your dollar, again, goes a longer way because the share price is much lower and there's more room for it to rise. But if we look at the other quick ones, your $1,000 cash divided by the share price would get you 10 shares of SDY. And then if you wanted to buy $1,000 worth of shares of VIG, that would get you 7 shares. And so again, the higher the share price, the less the less you can buy, obviously. But that's, again, you want to weigh the differences between every ETF and then try to make the decision that's best for you. So I hope you found that helpful, everybody, or I hope you got some value out of this episode. If you enjoyed it, please make sure you hit that like button. I appreciate it. Helps the page out. And if you want to see any more videos, make sure that you subscribe. I will be making 2 a week. The next video I'll be doing will be some Canadian dividend ETFs that you can consider for Canadian investors. But again, this one is for American investors. And last thing I forgot to mention, if you are Canadian and if you've yet to open your tax-free savings account, make sure you go to the link below. There is a link for Questrade. It's basically my affiliate link, as I've been using Questrade for 2.5 years and I love them. You use that link to open your self-directed TFSA. You get free money for doing so. And you can always reach out to me. I'll help you navigate the platform and get used to it. But that is it for today's video. Hope you found this useful, everyone. We'll catch you in the next one. Thanks so much for tuning in.